Consumer confidence absolutely plunged again in the month of June. Americans' assessment of the current situation fell at a rate we haven't seen but twice before in the 21st century, and neither one of those was 2008 and 2009. Things don't seem to be adding up in the US economy. Even the typically friendly financial media peppered Jay Powell with some toughish sounding questions this past week at the Fed's press conference. They were trying to get the Fed to start making some sense. Let's not forget the Fed's dots, too. The Fed rejiggered their dots more aggressively hawkish, and yet the market doesn't seem to care. Rates are going down anyway. The entire situation doesn't seem to add up. The Fed says the economy's strong and resilient. Americans increasingly say, what are you talking about? It's not strong and resilient. So let's start with consumer confidence. We talked about this last month because consumer confidence was down big in May, and it was expected to rebound in June, and it did not. It did not rebound at all. The consumer confidence from the University of Michigan fell to 65.6 from 69.1. That's the lowest since November, and it's down big since March. And this is a theme that we keep coming back to over and over again. There was a big economic inflection last year around October into November where the economy seemed to start rolling over. And now more and more we're hearing and seeing data that suggests the economy rolled over and inflected again, an acceleration to the downside somewhere around April and into May. We heard that from Target and retailers and restaurants and companies all over the spectrum. Now we're getting the data that shows, something big might have changed over the last couple months. Somebody needs to wake up Jay Powell. So according to the University of Michigan, their consumer confidence estimates, the assessment of the current situation fell all the way to 62.5 from 69.6 in May. Not only is that the lowest since December of 2022, it is down 20 points over the last 3 months. And the only other times we've seen that in the 21st century is obviously to April of 2020, the pandemic, the lockdowns. And the other time was actually Hurricane Katrina in the middle of 2005, late summer of 2005. You don't see Americans become this dour this quickly outside of those periods, not even in 2008. So Steve Van Metre, let's talk about consumers. What is it that you think consumers are seeing that maybe Jay Powell and economists and some parts of the financial media aren't seeing? Because we keep hearing how the economy is strong and Americans keep saying, oh, no, it's not.
Yeah, Jeff, the question is, what is Jay Powell seeing? Because seemingly nobody has a clue. But what's really interesting to me about consumer confidence is it's not unusual to see that it kind of rallied like we did, because when inflation comes down, consumers start to get excited. They actually believe that, hey, maybe there's a chance I'm going to get ahead because I'm going to keep my job. I'm going to keep getting wage gains. I'm going to actually get ahead. So we saw this increase, for several months over the consumer confidence, and now we're seeing it come down because there's one big change that happens. It's not that inflation's kind of gotten sticky or anything like that. It's the labor market's change, and that's the key point. They're seeing that I'm not going to have the big wage gains as before. I'm starting to get my hours cut. And people that are on unemployment, well, they're finding out there's no jobs for them. And even worse, those have been on unemployment, that are going on unemployment, are finding out that they're likely to stay on unemployment. And when people don't have money to spend in the real economy, at least not at the rate they want to, well, it's natural their confidence is going to plunge.
Yeah, that's the key point, especially when it comes to consumer confidence. You're right, because confidence had been rising really since 2022 as disinflation hit the economy and less consumer price gains were showing up. Consumers became it wasn't a huge burst of optimism, but they became relatively more confident throughout last year. There were ups and downs along the way, but generally the trend was positive. And then it was as if somebody just flipped a switch around March and it just kind of plunged all over again. And that's really the big point, Steve. What you just made is it's not about consumer prices. This isn't about a renewal of inflation pressures. It's not like we saw oil prices surge to $200 a barrel. This type of change in consumer confidence and rolling over and getting more weak, that's all about jobs and incomes. Even the press release accompanying the preliminary data from the University of Michigan said as much. The assessments of personal finances dipped due most modestly rising concerns over high prices, but weakening incomes. That's the thing we keep coming back to time and time again. Weakening incomes, jobs market, labor, all of that.
Jeff, it makes perfect sense because if you think about inflation, and let's say it's running at a rather high rate, compared to historical norms, but if my wages are outpacing that and my income is rising faster, then it doesn't matter to me because I have this certain feeling it's called getting ahead. And that's what, of course, consumers thought. They said, hey, you know what? We've been behind the curve for a couple of years here. Our wages just didn't keep up with inflation. And finally, maybe now, if inflation comes down like we're being told it will, that everything's going to be okay. And they didn't realize that as inflation came down, it's really a signal that demand for the U.S. economy was falling. And that's something that really, we didn't hear from the Fed or Jay Powell. They wanted something a little bit different. And in turn, that's led to, of course, employers saying, hey, you know what? Demand's falling here. So we're going to give you a raise, but it's not going to be as big as you really want. And oh, by the way, we've got to trim your hours because we just don't have the work for you. So the issue, again, is coming back to the fact that consumers were behind the curve. They thought they were getting ahead of the curve, so optimism went up, and now they're finding out that something serious has changed. It's not maybe that they're slightly below the curve. It's something significant, as you said, just changed.
Yeah, and it's not the payroll number, right? The establishment survey was another blowout number. And as many people have pointed out at his press conference on Wednesday, this past Wednesday, Jay Powell admitted, what did he say? That the payroll number may be, quote, a bit overstated. And of course, he was understated in making that admission because he's being forced to admit it, knowing full well that with all the rest of the BLS data, including the QCEW and some others, they're going to be revised substantially lower, and he's going to have to at least be on the same page as the BLS will be when those revisions come out. But the bigger question remains about what the situation in the labor market actually is. If we can't depend upon the payroll number, it is at least somewhat significantly less than the numbers are now. What is the real economic situation? According to the Fed, that's no big deal. Jay Powell said at his press conference, okay, the payroll report may be a bit overstated, but the labor market is still robust and strong. And in their last SEP projections, the Fed said, we don't expect the unemployment rate to go much beyond 4% or 4.2%, which is kind of a problem, don't you think, Steve? Because the unemployment rate as of last month was 4% already, and it's actually probably higher when you include labor market dropouts. So what the Fed was projecting here is that that the unemployment rate is going to level off right here as everyone is starting, consumer confidence is tanking. Companies are saying our businesses are falling. We're really supposed to believe the unemployment rate has reached its plateau here?
But Jeff, they have to say that. That's the issue, because what did the Fed tell us? That the second half of the economy year was going to boom. Well, guess what? We're here now. So if that's true, and we believe that, then this has to approximately be the peak of unemployment. It only makes perfect sense that they have to continue that narrative. But you and I both know that that is highly unlikely, because we've continued to see in these, PMI surveys and the Fed regional surveys that the manufacturing sector is slowing down quite a bit. Hours are getting cut. Wage growth is slowing. New orders are falling. Backlogs have been going on for more than a year that they've been getting trimmed. I keep wondering when they're actually going to run out of them. And we know that's going to lead to more layoffs. We know a lot of white collar jobs. People are on severance packages and they were thinking, no problem, I'll get another job. Well, at some point, if you can't, which is what we're seeing in the labor market, you look at continued claims right now, they're rising above 1.8 million. And yes, Jeff, I know that's historically low. And I know that's, what Powell and all the other political elites want us to believe, but it's coming off of a red hot economy. What this is telling you is if you lose your job right now, you might not be able to get another one. And that's the problem. We're going to see a lot of these people that are on these severance packages start to roll onto unemployment claims. It's just now a matter of time before those initial claims start to rise and start catching up with the continued claims, which is, I think, exactly what the University of Michigan survey is telling us, is something is desperately wrong.
Yeah, I want to go. There are a couple questions that were raised at the press conference that Chair Powell had a lot of trouble answering. And I want to get your take on them, Steve, because I think they're interesting and they really illustrate the difficult spot, as you pointed out a couple weeks ago, that the Fed has boxed itself into this spot. They basically said, we're so afraid of inflation because of the last couple consumer price numbers. They basically, just reacting to past CPIs, now they have to be aggressively hawkish when we continue to see, first of all, disinflation is still the predominant trend in consumer prices. But more than that, these constant acceleration and increasing signs of weakness across the economy. So here's one question, I think, from Howard Schneider from Reuters.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that, though. We look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
So basically, he's saying that we're not forecasting the economy to fall off all that much. So there isn't going to be slack in the economy that would lead to disinflation, at least according to how economists believe it. So what he's saying instead, we're just getting improving price conditions because the supply shock is fading further and further into the past. And I think what this reporter was asking is, why the hell did you bother raising rates in the first place if this is what was going to happen anyway?
But Jeff, we knew that. In fact, you said that was going to happen. That's the best part of this. And you think about, the pandemic shock, and it's almost as if Powell running his, economic models, which of course we know they really don't have what they want us to believe they have, that you actually turn the economy into a recession, which is exactly what we're seeing. And of course, if that happens, yes, prices come down because demand's going away. And how do we know that? Of course, Walmart, Target, McDonald's, Burger King, Kohl's. List goes on of companies that are starting to come out and saying, hey, wait a minute. Demand's evaporated. And all of a sudden it happened at once. Just like the consumer hit a wall. Instead, Powell should have come out and said, look, the issue is we need to get supply up. I'm fine with demand being where it's at. What can we do to raise supply? Of course, Jeff, you and I know the federal funds rate doesn't make supply go up either.
There was another question too, Steve, that went in the opposite direction, just to illustrate how ridiculous this whole press conference was. Michael McKee from Bloomberg Radio and Television asked, okay, if the economy's great, unemployment's not going to rise, what's the point of a rate cut?
The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. But so that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation with growth at a good level and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we're watching so carefully for signs of weakness.
And you could say, he wanted to come out and tell you the truth, which is, yeah, we think everything's in a good place, but the point of the rate cuts is that in case they're not. And so we're kind of hedging our bets here by setting it up that we can start cutting rates if, for example, the labor market is not like the payroll report.
Yeah, but Jeff, he knows that. That's the best part of it. We hear about the Fed being like, okay, we're worried about inflation coming back like it did in the 70s because our model suggested that's exactly what could happen again. But Powell's a really smart guy. He might not be a PhD economist, but he actually knows that this thing can tilt in the wrong direction. In fact, the historical odds that the Fed gets this wrong are somewhere right around about 100%, if my math is correct. So he knows that he needs a safety cut here because he believes in the magic of the federal funds rate, or he just needs to do something to convince people that he went from this highly restrictive monetary policy to less restrictive. And that's what he's going to spin and say, look, I know we don't need a cut here, but we went a little too far, so we've got to back it off. Because his real fear is if he gets this wrong, and he is, that he's going to send the labor market into a recession. Of course, the rest of the economy goes. And that's what we're seeing the early signs of. We can see it in the regional Fed surveys, in the beige book. It's really clear. I mean, he's reading it. We know he's a smart guy. And he's afraid. The problem is you get a hot non-farm payroll report. You get the CPI that just doesn't seem to want to come down. He's got to follow the data because that's what he tells everyone he's going to do. But the reality is he needs a cut here just to save face.
Yeah, it's all for show, right? I mean, this is all for public consumption. So you put so much stock into the payroll report that he knows is overstating the labor market. He actually admitted it. You put so much stock in the labor market, say the economy's booming, it's doing really well. Then you put so much stock in the CPI report. Well, it's been stuck at around 3%. We don't know why. We can't tell you why. So he, as you said, Steve, he's boxed himself into this corner. We're data dependent, and the data that we tell you that we watch is not performing the way we would really like it to, even though that's what he said. But basically, yeah, we're worried about the weakness, but I can't say that because the payroll report isn't actually showing any weakness. We're worried about consumer prices because we only react to the last CPI, and we have no idea where consumer prices are actually going to go. And it's funny, what to me, the biggest takeaway from the FOMC press conference is how some of these reporters who are normally, I mean, straight up cheerleaders for the Fed, these reporters were like, okay, Jay, we've got some relatively tough questions for you here because these things don't seem to make a whole lot of sense. And of course, he was struggling to answer them because he's not used to being questioned in any significant fashion.
No, you know what, Jeff? I think the biggest mistake Fed Chairman Powell made isn't going to be the mistakes he's making with monetary policy. It's not taking the victory lap when he had the chance. He should have come out and said, look what I did. Aren't I the best ever? But he didn't do it. And now the reality is these reporters are starting to look around just like you and I do and say, wait a minute, the economy isn't what you tell us. So why can't you see it? And then he's got to, box himself in, and he's stuck, and he knows it, and he doesn't want to be there. Again, the problem is he just didn't take his victory lap.
No, I mean, he was even asked that question at the press conference, too. Why do you think Americans are so unhappy with the economy? He had the opportunity to answer truthfully and say, yeah, well, it actually isn't all that good. But I mean, he's never going to be able to do that. But we get consistent information. The plunge in the University of Michigan confidence goes along with all sorts of other data that we're getting. And now the fact that reporters are questioning Powell over the same type of situation, same type of questions, it really just does. It just reinforces what we're seeing in the marketplace. The Fed raised its performative dots, but yields are going down anyway because the risks are becoming reality.